everyone. I'm Ashley McVicker, one of your hosts.
And I'm Jill Franks, your other host.
And you are listening to the Isn't That Rich podcast. We are actually dropping a very pertinent episode this week because some things are happening in the news that a lot of people are a little worried about, and that is the Silicon Valley banking fail. And so we're excited today because we have our CEO here, and he is going to be talking to us about what happened and kind of what to expect from the community bank and just easing your mind about the topic.
Yeah, we think as Farmers State Bank that we should always be really transparent with our customers and all of our listeners. And so we wanted to bring you a special episode with somebody who knows a lot more than we do about what's going on and hopefully put your mind at ease, like Ashley said, and just be able to answer those questions. So let's bring on Charlie. Welcome, Charlie.
Thank you guys for having me.
Thanks for being here.
So I bet you heard about the Silicon Valley banking fail and have learned a lot about it in the past week. I think we all have. So do you want to kind of give us just like a rundown of what happened?
Well, it's a little bit of a lot that's happened in a short bit of time. But, basically what happened, this is a large institution that had over 90% of their depositors over the $250,000 insurance threshold.
So large deposits.
Very large deposits, yes. And they weren't very well capitalized. They were well capitalized. I don't want to say they weren't, but they were lower. And what happened is they had bought a bunch of investments that had an accumulated loss that exceeded their capital ratio, and which was causing them a lot of pressure on a lot of different things. And these bigger depositors weren't borrowing as much money. They were using their money, because they're all venture capitalists and tech companies. I mean, this is all Silicon Valley area, and they were using their money instead of borrowing money, and it was taking too much money at one time for this bank to handle. So towards the end of 2022, they were already on the shrinking side on the deposits in 23, and it just kind of snowballed from there. So they wanted to reclassify their balance sheet, so they sold off a bunch of investments, and when they did that, they sold it at a loss, which caused investors to get worried. So they, started telling people to pull their money, and social media took a hold of it. Next thing you know, they were pulling money so fast that they couldn't keep up. FDIC had to step in the state of California to say, we got to close this till Monday so we can get our hands wrapped around this.
So, yeah, that's crazy. So it sounded like a lot of more panic is what was really driving
the social media, and the venture capitalists were telling people to get their money out. And that drove that. Okay.
So you mentioned a ratio. What was it?
It was their capital ratio.
Capital ratio. What is that?
That is how much equity is in the bank business.
Okay.
So
is there like a comfortable number that, or not really?
Well, I mean, theirs was around 5.25, and it, normally is around 8 and 9. So it was lower than that. They had, I can't remember offhand, but their accumulated loss was, like $5 billion more than what they had in equity. So, it put a lot of pressure. And when that happens, it's harder to borrow funds for the bank to help with deposits, and it's just kind of a mess.
Okay.
And so would you say, like in easier terms, really they had money lent out and then they didn't have the deposits to cover it?
They had money lent out, but a lot of their deposits were investments.
Okay. So explain to me how a bank works when that happens. So you take the depositor's money and then the bank puts that money to work.
They put that
in other
money to
investments.
Work. So they lend it out to other people, or if they don't have enough loan volume, they buy treasuries or municipal bonds or different things to get an interest that's higher than what they charge the depositors.
Okay.
And, the other thing that really hurt them was, they were buying these investments back 4 years ago, and interest rates were so low, and now the Fed has raised the rates as high as they have. And there's this big, huge loss that they, it's only on paper though, until they sell it. They have to, once they sell it, they have to recognize it. And that's what happened. They sold it, had to recognize that loss. It spooked the investors, and they weren't able to raise the capital they needed to shore up the bank.
I know I've been hearing on the news, and last night, everybody was talking about it on the news, and they said something about people withdrew over $42 billion in one day.
Mhm.
So for any bank to see something like that, I mean, there's no wonder with all that panic, what's a bank to do? I mean, that's
And that's the thing with what we can do now with it's so fast.
right.
With wires and ACH and P2P, and you don't actually have to come into the bank to get that money out. It can go pretty quick.
Yeah. So people were able to transfer on their own and move it on their own rather than coming into the bank, making the withdrawal and moving it.
But these are big venture capital companies. And I mean, if you saw in the news, I mean, Etsy was one of them. So, I mean, there were some big companies there, but, these venture capitalists aren't going to borrow money at 10% when they've got money sitting in their checking accounts. They put it to work.
Yeah.
And then it just took too much money out of the bank too fast.
So what got it to that point? Was it just bad management? How did it get to that point? I mean, was it?
Well, in the Silicon Valley Bank, to my knowledge, it wasn't necessarily poor management. They were on Forbes' list as the best bank to have. And then you had, people on TV months before that saying buy the stock. So
I heard like Mad Money was talking about it and recommending everybody go out and invest in Signature Bank not long ago.
Every bank business is a little different, and they chose a little riskier ventures with venture capitalists and tech companies and different things, but they were their customer base was big customers, and like a community bank, most community banks have maybe 20% of their depositors have over the $250,000 threshold. Now, this bank had 90%.
Okay.
So it's
wow.
It's a lot easier when one or two come in to take out, a few $1 billion that can go out really quick.
Yeah.
I mean, you're talking, like you saw Etsy and these are big companies.
Yeah.
They can swing those, but at the same time, it put those big companies in a bind too with being able to pay payroll because they couldn't use their checking account.
So I want to make sure I'm clear on this. Like Etsy, the company, had a bank account at Silicon Valley Bank.
Yes.
They had a bank. Okay, so that's where they banked.
Yes.
And then those companies were pulling their money out left and right. Okay.
Yes.
Wow.
Yeah. So that's kind of what happened with it. But I'm wondering, so what does that mean for everybody else and banks everywhere through the U.S.? What does this mean? Is it, it's created kind of a ripple effect, but what does it mean for us?
Well, and I think we should just you can talk about like the difference between what kind of bank Silicon Valley Bank is and what like our bank is, because there's different types of banks.
There are different type of banks, but the one thing that the Treasury Department, the FDIC, decided they were going to step up and pay all these depositors so they wouldn't lose a dime over the insurance threshold. And then you saw President Biden come on and say, taxes, you will not have to pay more taxes to cover this bank failure. That is true, except for the FDIC with their deposit insurance. The banks have to pay for this deposit insurance. So we all pay a premium for this insurance. Well, now all the banks are going to have to pay more to cover this failure and Signature Bank failure. Now,
so we're all kind of in it together, actually.
All the banks.
We're all in it together on having to pay back
FDIC
this failure.
insurance.
Yes. And you would think that it would be a bad, it's a bad thing. Yeah, we have to pay more. But the reality is it was a good thing for the government to step up and do to keep this from causing a huge run on all the banks.
Right.
Because the ones that didn't participate in this type of activity would hurt, too. And that's not necessarily right, and hurt our customers. So they did do the right thing. It's what's best for the whole, but it may make some bankers upset, but, sometimes you have to do what's best for everybody. There is a difference between Signature Bank and Silicon Valley Bank. I mean, every bank does them different, but the biggest difference is these are huge banks. They're not community banks. And the biggest difference, everyone thinks banks are banks, but they're completely different. Community banks are the smaller, under a few $1 billion in size. They support the community. These were, two of these bank failures in the top 25 largest banks in the country. And what's crazy is these banks, community banks hold just 25% of the deposit share of the country. And there's over 4,300 banks. Okay. So, over 50%, not 50%, 50 banks, not 50%, 50 banks control almost 75% of all deposit share.
Wow.
It's crazy that they control so much.
Mm-hmm.
So when you have a big bank like this and Signature Bank in this, when they are to fail, you're talking big companies that are dependent on them and all these depositors, millions probably of depositors that affect like that. Community banks, we have a different model. We're traditional. We do traditional lending, your home mortgages, commercial real estate, nothing really risky, because we're held to a different standard also.
Mm-hmm.
The regulators hold us a little different because we're not very big. While the bigger banks, they can do some more aggressive, they have all this AI, they have a lot of different things. They don't have the touch with the customers anymore. They don't know their customers. Community banks, we know our customers. We know the people that we're talking to. You have the big banks, they don't have a clue who they're talking to. And it's an AI and it's, they're running chat bots and all this different things, and they don't have a clue who they're talking to. It's a completely different model. I believe, though, that there is a need for big banks and community banks.
Yeah.
I just think it's good for people to understand the difference. Without community banks, the baseball fields don't get taken care of. The band doesn't get taken care of because the big banks don't donate to that. They do giant stadiums and arenas and all that kind of stuff. We support Main Street. So there's we're very important for that.
Mm-hmm.
But people need to understand the difference because, we take more pride in taking care of our customers and making sure their deposits are safe. And what we do is for the betterment of them, not just the betterment of trying to make more money.
This really did incite some fear into some people. And, the media has a way with that. And they have a really good way of planting fear inside our general communities. And so should people be afraid right now? And I think that's the main question. Should people be fearing for their investments and for that they're safe, their bank accounts are safe?
I don't think they should be fearing at all. Banks are making more money over the last 3 years than they have in years. Income is up. This is just some isolated incidents of just some bad thing happening at one time really fast. You usually don't see a bank failure in 48 hours. You just don't see it. This happened from like March 9th to the 11th and it was done. And the next day they shut down another one. So, it's not normal for that. Banks have been doing very well over the last few years. So, I wouldn't want anyone to think that right now banks and regional banks are in trouble. That's not the case at all.
Good. So it was more of an isolated kind of a thing. So what would you say to people who might be fearful? What are actions that they can take?
I think the biggest actions that you can take is go into your bank, go into your community bank. First of all, if you don't have a community bank, you should have a relationship with the community bank, and you may need a relationship with the bigger banks, but you should have a community bank where you can actually go in, talk to someone, and they can go through step by step on what is FDIC insurance, how can I structure this so I'm safe, what other options do I have, and really get to know someone at the bank, whether it be the president, the CEO, a loan officer, or
tellers, because they know
tellers or
everything
anybody,
about all that.
Build a relationship with someone at a community bank that can talk to you and give you insight, because you're not probably going to be able to walk into a Bank of America and talk to somebody and them make you feel safe, because they don't know who you are. Yeah. So that would be what I would tell everyone to build a relationship with a community bank, see what community banks are about.
Yeah.
They're made more for people and not numbers and huge entities.
Right.
So because this happened with these big banks, have you seen or heard about in our market, like the ripple effect of this happening? Like, is it falling down to the community banks or no?
In our market, we're not seeing it. There's not been withdrawals of cash or crazy behavior or anything. I mean, there's been a few that have called just for reassurance, but I mean, this really, is going to be okay. There isn't going to be a big fallout to all the community banks and all the banks. I mean, the banking industry has been around since forever, and FDIC insurance has been around for a very long time, and not a single person has lost a dime.
Yeah, because it's your money.
Correct.
Mm-hmm.
Correct. So, and the FDIC works extremely hard on when they take over these banks to recover everything they can. And again, we're not talking that they were doing bad things. It just happened pretty quick. So, there's not a lot of loss there. But again, like, I said that, their Treasury and the FDIC stepped up to make sure all these people are whole.
Any other business in America, you can talk about failing, and not to say it doesn't have a ripple effect, and not to say it doesn't make the headlines, but like, I think it's so crazy that a bank can fail, which a bank is just a business.
Mm-hmm.
And I know there's a lot of government regulations that go into it and all that stuff, but it is insane how newsworthy it is and how that can provoke such fear in people.
Mm-hmm.
Well, there's one way to get under people's skin is mess with their money.
Yeah.
Really quick.
Right.
And that's a quick way to put fear. I mean, because, in this case, it's a little different, but, most of the time in the small community banks, the larger depositors are the retirees because they've worked so hard and they've pulled it out of the stock market and they're living day to day off of that.
Mm-hmm.
So, to them, it's really scary.
Mm-hmm.
And today there's so much social media and so much news and even fake stuff that gets put out on social media about some of this stuff going on. It could cause a lot of fear for the retirees like that. But, again, that's where you've got to know your bank. You've got to be plugged into your bank. You've got to have a relationship. You can't rely on these big banks to do what's best for you when you can with the community bank.
Mm-hmm.
That's the trust that community banks have. And that's what I tried to pass on to our staff and our teammates is that, these people that come in are wanting a trusted advisor. They're not wanting someone just to give them yes and no answers or take their deposit or whatever. They want them to look out for them.
Mm-hmm.
Whether it's just, fraud or anything, if there's something going on, it's our job to take care of our customers and educate them on on their needs, what's best for them.
So if you could leave our listeners with one piece of advice moving forward in the banking industry, what would you leave them with?
I would say I would leave them with the banking industry is A-okay. There are no issues in the banking industry. It's supported well. It is examined well. This is 2 isolated incidences of some management issues that just happen to happen extremely fast. And I would not worry about the future of the banking industry and your money. Your money is safe staying in all banks.
Oh, good. That's good to hear. I love it. I really appreciate you being here today to kind of walk us through this because I know there are concerns out there. And like you said, being able to stop by your local bank and talk to someone who actually cares about you is really important at this kind of a time. So
absolutely.
I appreciate that. And I know everyone will be happy to see your face.
I appreciate you guys having me on. This is important to talk about, and it's always important to help educate and be transparent, like you said, transparent. So what you guys are doing every week for these podcasts are fantastic, and I appreciate it because it's really good for our community. Thank you guys.
And we're all going to be okay here at Farmers State Bank, right?
Absolutely.
In our community.
Absolutely.
Good.
Yes.
Thanks again, Charlie.
Thank you guys.